CSR. We, the members of Visakhapatnam branch, express our heartfelt thanks to the speaker of this session, CA Charmisha, for accepting our request to address the members of Visakhapatnam branch. Many successful companies have become world-renowned for incorporating social causes and social initiatives into their cultures, their values, and business strategies. Increased customer preference for social responsibility points to the importance of understanding how this type of philosophy can enhance their business. There are two different types of accounting CSR expenditure by the companies. First one is a scenario where the CSR activities carried out by the company of its own, and the second one is the accounting in other scenarios. Further, what is the recognition and measurement of income earned during the course of conduct of CSR activities and presentation and disclosure in financial statements of CSR expenditure? There are so many accounting systems and compliances in accounting of CSR expenditure. Secondly, the CSR audit is a formal strategic process that will help to measure the company's actual social performance against the social objectives it has set up for itself, and how the decision making, mission statement, guiding principles, and business conduct are aligned with social responsibilities. The audit helps in discovering the interests and objectives of the company's employees and stakeholders. To enlighten about the key accounting and auditing aspects of CSR, we have eminent speaker with us today, CA Charmisha from Mumbai. Let us gain thorough knowledge about the issues by the end of this session. Members, once again, I urge all of you to liberally contribute to CABF so as to strengthen the hands of our institute and to support our professional brethren. In this regard, we have started a campaign called YMM 30, that is Your Munificence Matters. We have started this campaign toward collection of CABF contributions to the tune of 100 lakhs from Visakhapatnam branch to ICAI. I request the members to come forward to support this noble cause with your liberal contribution to CABF. So now I request the immediate past chairperson of our branch, CA Bharati Dev Garu, to introduce today's speaker, CA Charmisha.
Thank you, Chairman sir, for giving me the opportunity. I am much privileged to introduce CA Charmisha, qualified her BCom from Mumbai University and qualified her Chartered Accountancy and practicing as proprietor of Shah Charmi and Co. And her areas of practice is in tax-related matters, statutory audits and internal audits, company law, ROC and other compliances. Professionally development activities. She has been served for different committees since 2016 as a co-opted member of Women Empowerment Committee of ICAI for the term 2021-22 and co-opted member of CSR Committee of ICAI for 2021. She was also a co-opted member of CCBMP Committee for members of Students Committee and Study Circle Committees, and also co-opted member of Direct Tax Committee of WIRC of ICAI for the year 2016-17. Members of Subgroup PDC Committee of ICAI in the year 2016-17. She has taken a lot of seminars on ICDS and income tax at different study circles of WIRC, Nasik branch, as well as Visakhapatnam branch of ICAI, and she is a regular speaker at the Chamber of Tax Consultants. She is also a regular faculty at CSR certificate course at ICAI. She has co-authored books on technical guide on accounting of CSR funds by third parties, handbook on certification of Form CSR1, handbook on audit of CSR activities, technical guide on accounting for expenditure on Corporate Social Responsibility Act. Apart from the above, she is also an avid sports person who has won a lot of medals and trophies in sports like badminton, table tennis, target rifle shooting and in yoga. She is a Mumbai district level winner in table tennis. She has also won lots of prizes in elocution and debate competition at various places. With these words, I introduce CA Charmisha to our members. Welcome, madam.
Thank you, Bharati Dev Garu. Now I request the speaker to take up the session, madam. So
Thank you.
Swarup will be coordinating for sharing this PPT. So as per your presentation, he will be moving the slides and coordinating. Okay, thank you.
Thank you, Bharti Madam, for the kind words. A very good evening to one and all. First of all, thank you, Chairman Sir, to give me a platform to express my views on the topic of accounting and auditing aspects of CSR. Thank you all the dignitaries on dais, Vasudev Sir, Prashant Sir, Bharti Madam and Murli Sir. Hope all our participants are in pink of their health and doing well, and most importantly, safe in this pandemic. So corporate social responsibility was the first time introduced as a statutory obligation for companies by the way of Companies Act 2013 under Section 135. Thereafter, the company rules were notified on 27th February 2014, which were called as CSR policy rules, to lay down the specification and procedures to be followed by the companies while discharging their CSR obligation. So Companies Amendment Rule 19 and 20 resulted in some major changes in CSR provisions under Section 135 of the Companies Act. To provide for the notified changes, the MCA had released the draft companies rule inviting public comments. So recently, on 22nd January 2021, the MCA finally issued the company's amended rules, which are called the new rules, giving effect to the changes introduced in CSR by Companies Amendment Act 19 and 2020. So these provisions shall not affect any CSR project or programs which are approved prior to 1st April 2021. So first, we will try to look at what are the changes which took place in amended act on 22nd January. Then we'll take up accounting and then we'll take up the auditing aspects. So next slide, please. Swarup sir, can we go to the next slide?
Swarup,
Is this the one slide?
Yeah, we'll go to the next slide.
Is it CSR definition?
it's not, no, only the first title sheet is only appearing. Swarup,
Actually, like I'm moving, but I think it is not getting executed. One more thing.
yeah, only title sheet is moving.
Yeah, 1 minute, sir.
Yes. This is not the first slide. We'll go to the first slide.
This one?
Yes, yes, yes. Requires legislation in India took place for Section 135 in the Companies Act. But let's look at how it got evolved from 2013 to 2021 Amendment Act. So the enactment of the Companies Act 2013 gave the way to CSR in Companies Act, which is predominantly, and the corporate governance issues have come up. And now it was very important step that the CSR found way in Companies Act. India was the first country at that time to do so. And of course, by the help of Section 135. So later on, there were many amendments that happened to it. But the key that happened was a constitution of high-level commission in 2015 for improved monitoring of implementation of CSR policies. In 2015, unspent balance of CSR fund is to be carried forward. Unspent balance is to be transferred from one fund in Schedule 7. That was introduced. So board and CSR committee was responsible for the due diligence of implementing partners. In 2018, another high-level committee was set up. They included carry forward of unspent balance for a period of 3 to 5 years, imposing monetary penalty for non-compliance, mandating impact assessment, strengthening the reporting for CSR, registration of impact assessment with MCA, additional 5% admin expenses for the company undertaking need and impact assessment, etc. This things was recommended by the high level commission. In 2019, companies amended 2019, including what did that include? It included immediately preceding financial year for eligible Section 135 applicability. But something which was not notified was transfer of unspent amount to fund mentioned in Schedule 7, carry forward of unspent amount of ongoing project, introduction of penalty clause for non-compliance, including imprisonment. And in 2020 notification, there were changes like carry forward of spend, unspent amount relating to ongoing projects, transferring of unspent amount not relating to ongoing projects into Fund 7, 7 fund, monetary penalties, etc. So now this amended rules 2021 shall come into force on the date of its publication in its official gazette, that is on 22nd January 2021, unless explicitly provided in any elsewhere in the notification. So while some of the amendments will actually be relevant from 1st April 2021, some of them will be immediate compliance implementation. So let's first look what was the amended act which took place on 22nd January, which are very important for our accounting as well as auditing aspects. Let's go to the next slide. This slide is new rules significant. Why are the new rules significant? Because there are changes in the 5 provisions. First is the CSR definition, which is changed. Shift from directional to mandatory CSR. First, it was only directional, but now it is become mandatory to do its CSR obligation. Then registration requirement for implementing partners, increased rigor for internal control, and focus on impact creation. So all this we will look at in detail in the next slides. Can we go to the next slide? Yes, CSR definition. As a result of new rules, CSR is now defined in the section 2D of the Companies Act. The amended rule further identifies the activities which do not qualify towards CSR requirements of the company. Let's look which are the activities which are excluded from the list of CSR activities. The first one is the activities undertaken in pursuance of normal course of business or company. The question arises whether the employees can be migrated to their home by the company and that amount can be granted as CSR. So many circulars and notifications came out during the COVID times which clarified that migration of other workers can be claimed as CSR. But migration of their own workers will not be taken as CSR activities. So normal course may include sale, supply of goods and services, so not part of a CSR. So mere absence of profit motive will not take an activity out of its normal course of business. So however, in view of the COVID pandemic, an exception to this was created by the way of MCA notification dated 24th August 2020. Allowing companies engaged in research and development activities of new vaccine, drugs, and medical devices in their normal course of business to undertake such research and development in relationship to COVID-19 as their CSR obligation. But this was only for 3 financial years, that is 2020, 2021, 21, 22, 22, 23. And this exception was duly incorporated in new rules subject to some conditions. What were the conditions? That first, such research and development activity shall be carried out in collaboration with any institute or organization mentioned in the clause of 9 of Schedule 7, including public funded university, IITs, Indian Council for Medical Research, etc. And the second condition was the details of such activities shall be disclosed separately in the annual report of CSR included in the board's report. Second is, any activity undertaken by the company outside India shall not be considered as CSR except for the training of Indian sports personnel representing any state or union territory at national level or India at an international level. Before the amendment, it was activity outside India only. There was no exception to this clause. But now they have made a little change that included Indian sports personnel representing any states or union territory. The third exception is contribution of any amount directly or indirectly to any political party which falls in a section 182 of the Act shall not qualify as CSR. This point has no change. Before the amendment also it was the same. The fourth activity is activity benefiting employees of the company as defined in the Code of Wages Act. This is a very important change that have took place. Two key points that are changing here is activities benefiting employees of the company is employees under Code of Wages Act. This is a very significant change, and the meaning of the word employee that is now connected to Code of Wages. So for our understanding, the employees or people which are hired for reward are only taken. Moreover, they also are of the opinion that whether the Gratuity Act definition would be included or the contractual definition of the employees would be included here. And that is a big gray area till now. Coming on to the second point of employees benefit part is that the draft rules which came in March 2020 indicated significant benefit that talked about 25% of the benefit. Now the amendment which has come in is too specific and takes away the word significant. Initially, the word significant was used in this exclusion. So to that extent, any benefit that goes to the employees or any project which goes to the employees which actually gets disallowed now. The second point which comes here is the word family. The initial draft 2020 spoke about the family and its benefit. The current situation says that the word family is taken away, which so that the interpretation becomes that benefiting family will be considered to be CSR. So the question arises that does it mean that the employees cannot be beneficiary of the CSR project if done to the society at large? To understand it, let's take an example. A company made hospital beds for society at large. But in those beds, there is no special reservation for the employees of the company. But in case they use it normally as others in the society use it, that does not mean that the amount is spent on employees. And that amount will not be also reduced from CSR spend. That will be allowed as CSR because the employees are not getting any advantage over the society people. So such kind of CSR would be accepted as CSR amount spent. And the last one is activity supported by the companies on sponsorship basis for deriving marketing benefit for its product or services. Here there were FAQs released by the MCA. So let's take first example of a favor marketing. Favor marketing means any marketing which gets benefited to the company in the way of doing CSR. So if sponsorship has been done for the product, but not deriving benefit for its own product or services, it is called not favor sponsorship. So let's first take an example of favor marketing. So if XYZ organization takes up an initiative of sponsorship of a part of some urban city, considering environment, sustainability, hygiene perspective. This is unlinked to their product. So such kind of one CSR project can be taken up by the CSR committee of the company, and it is not benefiting the company and its CSR activity. So such CSR activity will be allowed. But in case, let's take a second example of a bank. A bank motivates its customer by and says that if you spend 5 lakh rupees on credit card, then we will contribute. We means the bank will contribute 500 rupees towards charity activities. So the question arises, is that spent 5 lakh rupees or 500 rupees by the bank is a CSR spend? No, such CSR would be disallowed, and since there is a direct consensus with the development of the business of the bank, this cannot be considered as CSR. Many times organizations supply or sponsor ball pens and materials. Here we have to see whether there is a direct or indirect nexus with the development of the business of the company while doing CSR or not. So the CSR committee has to do a sensitive analysis to conclude, is there any nexus to the benefit by the CSR activities to the company or its company's product or their image. We have to, the CSR committee has to look at the projects of facts finally to find out whether the CSR activity would be allowable or not. The board and committee has to take this view very sensitively and taking all the aspects of the activity plan very deeply. But the main role and the important role which can play to decide whether it is a CSR activity benefiting the company or not is the language in the agreement between the company and the CSR implementing partner or the company if it does on its own. The agreement plays a very important part. So for example, COVID-related awareness is specifically permitted as CSR activity as per circular dated 12 January 2021. So there can be too much marketing advantage for this too. But as per the new amendment act, it is allowed. So this can be a benefit to the company itself. So the example one more we can take in this is that the company has built a water cooler everywhere in the city and it has carved its logo on it. This logo can be used in its marketing purpose, which makes it a brand visible. So just as it can capture market by inscribing their logo on its water cooler, it does not deprive the company to recognize it as a CSR activity. So in such case, it is considered as CSR activity. The last one is the activities and fulfillment of obligation under any other law in force in India. So these are the changes in CSR definition. Let's go to the next slide. So there are three definitions which are changed in this amended act. And these three definitions have played a very important role in the accounting aspects of CSR. First is ongoing project. Ongoing project has finally been defined to mean a multi-year project undertaken by a company in fulfilling of its CSR obligation to the maximum allowed duration of which is 4 years. What are the 4 years? 3 years excluding the year of the commencement of the project. So 1 year in which you start the project plus you get the 3 years. So 1 plus 3 years you get then maximum duration of a multi-year project. So the definition also includes projects that were initially not approved as multi-year projects, but are later extended beyond 1 year by the board on reasonable justification. Board means the company is board. So ongoing projects entail certain added responsibility for companies, such as requirement to monitor their implementation as per approved timelines under the rules. In these rules, an attempt has been made to define ongoing projects, and many ambiguity has been done off with the inclusion of the definition of ongoing projects. It says that implementation of which goes beyond the stipulated period of 4 years is also allowed. So the company may not be able to undertake such projects as CSR activity because they shall not qualify as ongoing projects, and any unspent amount in that regard shall automatically be transferred to the fund specified in Schedule 7. Now let's take example of what is said to be ongoing projects. So if company contributes to annual running expenses of a cancer hospital, the spending for the next year cannot be regarded as an ongoing project, because every year it gives an annual running expenses. So for 1 year, it is only said the project to be 1 year and it is not considered as ongoing project. The second example is installation of a new facility at the same hospital. Same hospital means if a company runs the annual running expenses of a cancer hospital, as well as in this year it has started installation of a new facility. So if already the company has started giving a facility, then it can be regarded as ongoing project. So to regard it as an ongoing project, is it necessary that some spending must have been done during the year? So the answer is, if there is a binding commitment on the part of the company during the financial year, the fact that nothing has been spent during the year should not preclude it from giving it as an ongoing status. So the essence of the retention money is rolling the expense to the next year and claim it expense of this year. So target spending or not spending amount on ongoing projects should be disclosed in its board report. The second definition is administration overhead. The administration overhead is a new term defined, and it is also said as general management and administration in relation to its CSR functions. So the definition explicitly excludes expenses directly for designing, implementing, monitoring, and evaluation of a particular CSR project from the ambit of administration overhead. So the board was required to ensure that the administration overhead incurred for CSR do not exceed 5% of the company's total CSR expenditure. So the meaning of administration overhead was, however, not specified in the draft rules, but assigning a definition to the term in the new rule is a welcome step, as it gives a greater clarity to the companies. So in our opinion, the government should also mention a few examples of cost that are qualified as administration overhead for better understanding of our term, scope, and ambit. So this amended rule says that the board has been given the responsibility to ensure that the administration overhead in relation to CSR do not exceed 5% of the CSR expenditure. And it is also noted that the draft rule has an upper limit of 10% for administration overheads. So the new rule says that carrying out of an impact assessment also gets included. So 10% includes impact assessment as well as administration overheads. So administration overhead takes 5%. So in turn, impact assessment can be taken as 5%. But the rules have specified that the rule 8.3c of the new rule says that the impact assessment can be claimed as 5% of CSR expenditure or 50 lakh rupees, whichever is less as an CSR expenditure. Moving on to the next definition, that is eligible entity. Eligible entity is defined in Rule 4.1. So this rule says that the board of the company shall ensure that the CSR activities are undertaken by company itself or through third party. The third party is defined in this rule. So what will be the eligible entities as per third party? There are 4 parts. First is the company established under Section 8 of the Act, registered under public trust or registered society, or registered under Section 12A ATG of the Income Tax Act, established by the company or any other company. The second comes a company established under Section 8 company, registered trust or registered society established by the central government or state government, or any entity which is established by the Act of Parliament or state legislation. And the fourth and the last eligible entity will be a company established under Section 8 of the Act or registered public trust or registered society, registered under 12A and ATG of the IT Act. But from this Amendment Act, this is very clear that the company has to take the implementing partner which has an established track record of at least 3 years in undertaking the similar activities. So in case where the board of the company is not carrying out CSR activity by itself and undertakes through third party, till now there was no platform for identification and registration of such entities. So in such cases, presently a company had to follow a thorough and a stringent selection process so as to ensure that the organizational goal towards CSR are achieved in the most transparent, effective and efficient manner. Further, the company interested in engaging third parties for implementation of CSR activity had to scout for appropriate entities on its own. So the database of the registered implementing agency would become handy tool for the companies looking for implementing entity. The government has taken this step. Let's go to the next slide. So the Ministry of Company Affairs, by this amended rules 2021, shifted CSR spending from mandatory from voluntary to mandatory. So in one of the article said that India has equated CSR with spending part, whereas in other countries it is equated with the responsibility part. But in India, spending is the main crux while deciding whether the company has done its CSR activity or not. So what are the implementation in case of any amount remaining unspent at the end of the year? So if there is a CSR liability by the company, it has to decide whether there is if the entire amount is spent during the year, it has to report in its director report. Or second case, maybe the entire amount is not spent. And if the entire amount is not spent, we have to decide whether it is an ongoing project or it is not ongoing project. If it is an ongoing project and the amount remains unspent at the end of the financial year, then within 30 days, it has to deposit it into an unspent CSR bank account. A bank account named unspent CSR account should be made, and within 30 days from the end of the financial year, the amount has to be transferred. Now, in case it is not an ongoing project, then the unspent amount has to get transferred to the government fund notified in Schedule 7. Schedule 7 is specifically given in the Companies Act, and it has to be transferred to that government fund. In case of ongoing project, and you have transferred the amount to unspent CSR bank account within 30 days of the end of the financial year, after that, at the end of 3 years, still that amount remains unspent, then it has to get transferred to the government fund notified in Schedule 7. So for ongoing project, first you have to transfer the amount in unspent CSR bank account, and after 3 years, if it is not yet spent by the company, it has to get transferred to the company's fund, government fund notified by Schedule 7. So up to March 2020, we used to spend 2% of the average net profit of the preceding 3 financial year as CSR expenditure. And if not spent, the company had given reason in its board directors report. But the Companies Amendment Act, as on 22nd Jan 2021, says that if you have not spent, then you have to give it to any specified fund if it is a not ongoing project. Rule is that the unspent amount of not ongoing project has to be deposited in Schedule 7 within 6 months, that is September 21. So earlier there was not mandatory to make provision for the same in the books of accounts. But now it would be mandatory to make provision for the unspent amount in the books of accounts. So either you spend the entire amount during the financial year, or if it is not spent, you have to make a provision for the same in the books of accounts. So the question arises for funds which do not get spent up to March 2020. The company can dealt it in the two manner, where it was unspent, they disclosed, but no provision was made and just gave reasons in their disclosures. But the other way was they made provision in the books as unspent CSR account. So now, if this amount are not used by March 2021, this has to be transferred as per rule to Schedule 7. So it can be said that this amount does not belong to this year, so it should be deposited in the bank depending whether it is ongoing or not ongoing. This remains, for example, if project is not finished as it is ongoing project. So I park my money in the project, then identify that amount required to be done in the project for not indefinite period, but only maximum 3 years. And for that, you have to identify an outlay required on ongoing project. That is one part. So the CSR committee has more responsibility to also find out what will be the amount required for the next 3 years on this ongoing project to make a provision of it. The second part is the amount not retained. So the amount which we cannot retain by us at the end of financial year can be transferred to National Unspent Fund within 6 months of the end of financial year. The rule specifies that the fund in which the amount of CSR unspent has to be transferred is called the National Unspent Fund. But till now, the government has not formulated the fund called National Unspent Fund specifically. So in that case, till September 2021, they do not create it, we can deposit it in any fund which is specified in Schedule 7. So we actually do not have total 6 months to decide whether we are retaining the amount as ongoing project or we are getting transferred to Schedule 7. Because for retaining the amount in ongoing project or non-ongoing project, we need board approval for retaining the amount or transferring it to the Schedule 7. And the board's approval needs to be taken in the board meeting, which are mostly within 2 months from the end of the financial year. So effectively, in my view, you only have 1.5 months from the end of the financial year to decide whether it is ongoing project or what amount has to be kept as retention in ongoing project or not ongoing project, what amount we need to transfer it into Schedule 7. So physically to transfer 6 months in the funds, we have 6 months. But to decide and take board approval, we only have 45 days to decide, because after 1.5 months, 2 months, we have the first board meeting and we need to pass a board resolution for any amount which we capped it as unspent amount or in transferring in any Schedule 7. So board's approval shall be taken for ongoing projects for maximum 4 years, that is 1 plus 3 years. So why this 3 years limit is kept? Because they want the rule says that the company need not have visibility for only 3 years, but they want that after 3 years they monitor and implement new eras and arenas in the same projects. So for monitoring the same ongoing projects, they have kept a limit for 1 plus 3 years. Moving on to the third point, ongoing project. Board to monitor implementation of our ongoing projects and shall be competent to make a modification if required. So board monitorization and not the committee is competent. Board also has the power to implement any projects. On board's approval, excess CSR spending allowed to be carried forward for succeeding 3 financial years. For example, if a company has to spend 10 crores in a financial year on CSR and it actually spends 15 crore rupees, so that is 5 crore excess spending, and this 5% excess spending can be carried forward to the next year and can be set off with the next preceding years. So for the next year, if the amount spending would be 7 crores as per calculation as per section 135, 5 crores is already spent in this year. So net only 2 crores is need to be spent by the company for the next financial year. But setting of excess amount for next 3 years only. So this 5 crores can be carried forward for next 3 years only. And if it is not set off in the next year, it gets lapsed at the end of 3 years. But 2 conditions has to be fulfilled. The first is passing a board resolution, and such CSR projects should not include any surplus arising from CSR projects. Next slide. Capital assets. Capital asset is a definition is very well explained in this CSR rules. Another new rules, a company is further allowed to spend CSR amount for creation or acquisition of a CSR asset. A company established under Section 8 of the Act, a registered public trust or a registered society having charitable objects and CSR registration number. From this year, the amendment rules has made that the CSR registration number is very compulsory for any implementing agency. And any implementing agency who do not have a CSR registration number will not be allowed to do its CSR objective for any company. So CSR registration number will be done by registered by the trust or the society with the MCA by filling up CSR form 1. And the second is beneficiary of the said CSR project in the form of self-help group, collectives, entities, etc. The third is the public authority. The public authority is very well defined in RTI Act, which says that any institution or body which is established by the constitution, any law of the parliament, or any other law made by state legislation, notification issued, or any body owned, controlled, or sustainability financed by any non-government organization. So as argued by the high-level commission on CSR 2018, the rationale behind allowing the companies to use CSR amount for capital creation or acquisition is to encourage sustainable and effective initiatives. So the idea is not to limit CSR amount to revenue expenses and instead use it for creation of capital assets, which would yield future economic benefit. So the genesis comes from high-level commission report that government has felt that overall intent to work for public good. But there were companies who were saying that they are doing CSR, but in turn they were just creating assets in their books which was getting appreciated. So for example, if a company is running business through an NGO and acquiring land and building, now NGO is running the school, but the building is sitting in the books of the company and it's getting appreciated. So the next example is a mobile healthcare van. It is run for public good, for healthcare for public, and it is also running on by the NGO. But now it is that mobile van is sitting in the books of the company and getting appreciated. So in such cases, the overall intent of legislation is to work for public good and has practically said that now all these companies have to keep their assets in the books of NGOs or the implementing partners and not in their own books. And this existing capital asset is to be transferred within 180 plus 90 days. So any capital asset created by the company prior to the commencement of the company's rule 2021 shall within the period of 180 days from the commencement of this rule, that is 22nd January, which may extend by 90 days by the board's approval. Without approval of the board, the extension of 90 days cannot be given. So you have to identify the company. In fact, the company has to identify and transfer that asset in maximum 180 plus 90 days. And going forward, it would be too important for the board and the CSR committee to really look forward that if any asset is to be created, then the ownership needs to be with each of this body, that is the company itself. slide. We can go to the next slide. CSR committees. So according to section 135(1), each company having net worth of more than 500 crores or turnover of 1,000 crores or net profit of more than 5 crores during any financial years shall constitute a CSR committee of the board, consisting of 3 or more directors, out of which at least one director shall be an independent director. Before the amendment, during the 3 preceding financial year, now it is any financial year. So when any amount is to be spent by the company does not exceed 50 lakh rupees, the requirement for the constitution of CSR committee shall not be applicable. So this is one of the relaxation which is given by the amended rules. So if the committee is formulated, the board has to given the power to alter the annual action plan in accordance with the CSR committee's recommendation based on a reasonable justification. So while comparing the new rules with the original provisions of CSR committee, the new rules appear quite detailed. The earlier Rule 5 vaguely mentioned instituting transparent monitoring and mechanism of CSR implementation without specifying its requirement. But the new rules made a process easier by laying down what all needs to be necessarily be included in the board in its action plan. So pursuant to the new rules of the CSR committee has been given the task of formulating and recommending the boards an action plan in pursuance to CSR policy, and the aforesaid plan shall include list of CSR projects to be undertaken under Schedule 7 of the Companies Act, manner of execution of such project, modality of utilization of funds, monitoring of reporting mechanism for the project, and details of need and impact assessment, if any, for any project undertaken. So can we go to the next slide? So now there is mandatory registration with the central government. So it was in the draft rule that to make that this is a regulatory concern, but as of now, only required to do registration. Maybe in future it can be regulatory in nature. So form CSR 1 is to be filled electronically and submitted to the register of companies. These rules have mandate to fill in form CSR 1. And what is CSR 1? It has to be signed and submitted electronically on MCA portal and shall be verified digitally by CA in practice or company secretary in practice or a cost accountant in practice. So on submission of CSR 1 on the portal, a unique CSR registration number will be generated. And this CSR registration number is very much required by each and every implementing partner, which I have already discussed in the previous slide. So CSR registration number of implementing partner is to be disclosed in Annexure 2. So now it is being compulsorily has to be disclosed in Annexure 2 of the board's report. So if any implementing partner do not have a registration number, it will not be allowed by the company as per this rule to do implementing. So this form CSR 1 is termed as form for registration of entities for undertaking CSR activities. The form mainly consists of 2 parts. First part is information part of the entity, whether it is Section 8 company, it is trust or society, what is its DIN number, what is its address, email address, postal address, mobile number. And the second part is the signature part. Now, it requires for implementing partner of the approved prior to 1st April 2021. So if ongoing project, this is not required. If any implementing agency do not have a CSR registration number and it is still doing its work prior to 1st April 2021, then it is not required to get itself registered and it can continue its work. Implementing partners has to register under Section 12A and 80G of the IT Act. So therefore, it seems that only ongoing projects may be carried out by unregistered implementing agency. There is some consensus that CSR expenditure will not qualify for tax purposes. Then the question arises that why are you bringing Section 12A and 80G mandatory to register for register of companies? The only answer is two reasons of this requirement is. First, because 12A and 80G registration organization is better monitored by authorities and they will have all the filings with them. So from next year, all old charity organization who is registered under Section 12A and 80G will require re-registration. So now they have better control, and second possible reason is last certain years, lot of not for-profit organization who have come forward and said to the government that we want to become the implementing partners. So now government want to plug them into becoming implementing partner. So that is only possible reason why this requirement has come in for each and every charity organization to make themselves register. And this filing of CSR 1 electronically is applicable with effect from 1st April 2021 and not from 22nd January. Swarup sir, can we go to the next slide?
Ma'am, I actually enabled remote control option, gave you the access. Can you please hit the next button in your keyboard?
Okay. Yes. Increase in internal control. One second. Impact assessment. So this impact assessment is becoming mandatory. So impact assessment is limited to 5% of the mandated CSR or INR 5 million, whichever is less. So first we need to check whether any three conditions have been taken care of for impact assessment or not by this new rules. So the company with average CSR obligation of INR 5 crores or more in immediate preceding financial year shall take impact assessment through independent agency The second thing is impact assessment to be taken for CSR project with outlines of INR 1 crore or more. Impact assessment to be undertaken for projects completed not less than 1 year before undertaking the impact assessment. Impact assessment reports to be placed before the board, and the details and report of impact assessment undertaken and amount spent on the same is to be disclosed in annual report. Thus, after the notification of the new rules, company qualifying to mention the threshold shall be mandatorily required to carry out impact assessment of the CSR contribution. So it is hoped that such a requirement will result in more meaningful contribution by the companies towards the society. So there is, however, scope for clarity with respect to the provision allowing companies to claim 5% towards CSR expenditure for impact assessment. So prima facie, it gives an understanding that such company have the option to claim 10% in total as their CSR expenditure, 5% as administration overhead and 5% as impact assessment. Although the same has not been explicitly mentioned in such clear terms that 5% has to be specifically for administration and 5% for impact assessment, but the overall limit is given to be 10%. So statement from the government is on this behalf is very much appreciated to remove the ambiguity of this 5%. So earlier it was ambiguity, but the definition now is clear that the expenses by the company itself, which is contribution to the NGO. So NGO you have to take in for implementing the direct project expenses or project overheads. International organization. So 2021 amendment introduced a new term, international organization, which is defined in section 2G of the United Nations Act of 1947, to which the provision of the schedule of this act has direct nexus have taken from. So the High Level Commission on CSR 2018 said, headed by Injeti Srinivas, has recommended the introduction of international organization in India's CSR region. So the recommendation has been duly incorporated, pursuant to which the companies are allowed to take help of international organization in designing, monitoring, and evaluating their CSR projects, and also assisting them in capacity building for their personnel. So it is noted that draft rules are also proposed engagement of international organization with respect to implementation of CSR project subject to prior government approval, but the same has not been notified yet in the new rules. Penalty clause. The penalty clause in case of a company. Why is the penalty clause included, and when the penalty will be applied? If the company fails to disclose unspent amount in annual report on CSR, second, transfer unspent amount into fund specified in Schedule 7 within specified time, transfer unspent amount relating to ongoing projects into unspent CSR account within specified time, and transfer amount remaining utilized in unspent account after 3 years into funds specified in Schedule 7 within specified time. We have already discussed when we have to transfer it into Schedule 7 or within 30 days. So if the company fails in doing any of these things, then penalty is levied to the company in default. What is the penalty? Lower of the amount, twice the amount required to be spent to the company to fund specified, or 1 crore, whichever is less. And if the company says that any of the officer is in charge in default, then the penalty to the officer would be 1/10 of the amount required to be transferred by the company to such funds specified in Schedule 7 or unspent corporate's CSR account, or 2 lakh, whichever is less. Now moving on to the next, that is accounting. Accounting can be two types, social as well as financial. Social accounting requires various accounting of economy, but just let's look at financial accounting. How should be accounting in books of accounts? We are here to see how accounting to be done for CSR expenditure. For knowing what should be done in accounting, we should look into section 135 of the Companies Act 2019. So the amount of contribution made towards CSR would be generally treated as an expense and charged to profit and loss account. So unless it gives rise to an asset, according to the guidance note of CSR, then amount would be recognized on basis of an evaluation of control over assets and accrual of future benefit of the company. So for learning what would be accounting as per CSR, the accounting would be as per section 135.5. What does section 135.5 says? The board of every eligible company shall ensure that the board spends in every financial year at least 2% of the average net profit of the company made during the 3 immediate preceding financial year in pursuance of CSR policy. And if in the case the company has not compiled 3 years of its incorporation, then such number of years. So for calculation of net profit, average net profit, it would be net profit before tax as per calculation of section 1, as per calculation given in section 198 of the Companies Act, which is read by 197 of the Companies Act. In this, they have given a specific format in which we have to include or what not to include in calculation of average net profit for CSR. So section 135.5 provides the company shall give preference to local areas and areas around it where it operates for spending the amount earmarked for CSR activities. And this is specified in circular of 6/2018 dated 28th May 2018. So now let's look what would be the accounting when CSR contribution is received in these 4 ways. That CSR contribution received from various projects. What would be the accounting aspects? So if the third party or a company itself is receiving contribution from different company for different projects, then the amount should be identified project wise, and the receipts as well as the amount spent corresponding to that project should be marked and reflected separately. Both the contribution received and the expenditure made should be charged to income and expenditure account of the third party, that is the implementing partner. And fixed asset, if any required or acquired, should be taken to the balance sheet of the third party. Second case is return of unspent amount. The CSR donations received by the third parties must be applied for charitable purpose within the specified period as per project or program which is specified by the CSR policy by the donor. So in case the CSR donations are not utilized within specified period during the year, the same may either be returned to the donor or same would be utilized as specified by the donor company. So in case of return of unspent amount, the accounting entry would be CSR contribution A or project A. As we are specifying project wise, we are writing project A, project B, project C, whatever. So when the amount for project A is returned back by the implementing agency, we have to write CSR contribution to project A account debit to bank account. So third is accumulation of unspent amount. So in case the amount is required to spend on project remains unspent at the end of the year, then the entity needs to accumulate the balance amount to be utilized in future period. So such unspent amount at the end of the year would be carried forward to the next year and require compliances or formality. What are the compliances? If it is in charitable institute that is implementing partner, it has to get registered under income tax provision of 12A, ATG. It should be done properly. And if the entity is required under section 12A, then the charitable entity needs to e-file form 10, specifying the purpose for accumulation before filing the return of income. But as per accounting, what will be the accounting entry would be CSR's contribution to project A account. Let's take that it is for project A itself. So accumulation would be like CSR contribution project A account debit to CSR fund project A account. And this fund which is created, the CSR fund project A, should be taken to the balance sheet. Taking on to the fourth part, expenditure out of accumulated unspent amount. When the required compliances are made under IT Act, the accumulation of 5 years is treated as application of income in the year of accumulation under IT Act. So in subsequent year, when the expenditure is made from that accumulated amount, let's see what would be the accounting entry. The accounting entry would be CSR fund project A account to bank account. So the amount spent out of this accumulated fund would not be charged to income and expenditure account. It would be from the fund which is standing in the balance sheet or the fund which is created in the balance sheet. Now let's look at what is the recognition and measurement of CSR expenditure. The accounting relating if the accounts and the CSR expenditure is taken by the company itself, or the company only spends the amount, or it just contributed to the fund, or if the company takes the CSR by its registered entity, then what would be the recognition? It would be charged to the statement of profit and loss account. So in any case, in any scenario, the recognition would be as an expense in P&L account. What will be the recognition as per unspent amount? The unspent amount would be as per section 135 and 136 of the amended act. To just give a brief view that what was the section 135 of unspent account would be for ongoing projects where we had to transfer it to within 30 days from the end of the financial year, and 136 it was not ongoing projects and had to be transferred to the fund specified in the schedule 7. The next scenario is what would be the recognition and measurement of CSR expenditure in case where there is income surplus earned from CSR projects or programs. So any surplus arising out of CSR activity shall not be formed as a business profit. So such surplus shall be used on the following within the end of 6 months from the expiry of the financial year. Three things. First, it would be plunged back to the same projects. Second, it would be transferred to an unspent account, CSR account, or it would be spent in pursuance of the CSR policy, which is framed and annual action of the policy. So the surplus would be within 6 months. They have to decide whether it has to plunged back in the same project, or it has to transfer it to unspent account, that or it has to be spent in pursuance to CSR policy. CSR expense wrongly claimed as product or service cost is not shown separately as CSR. It has to be recognized as a non-cost item and been declared in the CSR policy of the company and reflected in the profit reconciliation statement. What are eligible expenditure? Whether a particular expenditure spent on CSR will be allowed under the IT Act for the company will depend upon its nature of expenditure. So whether it is revenue or it is capital nature. So first let's look what will be accounting on revenue expenditure. Is CSR is a revenue expenditure if a company has incurred expenditure on activities specified in Schedule 7 of the Companies Act, and if CSR expenditure relates to business of the entity, then such expenditure should be treated as an expense in the statement of P&L. In case the company receives any grant from the government for its CSR activity, then the CSR activity would be net of that grant amount. And in case of capital expenditure, it has to check Section 35 of the Income Tax Act. So whether it falls under any of the statements of Section 35, then it would be allowable expense under IT Act. And if it is not there, then it would not be as an allowable expense. The last one is income earned during the course of conduct of CSR activity. So any surplus arising from CSR activity is not arising from the transaction with its owner. So it would be considered as income for accounting purposes. So auditing, as in chartered accountant, it is very important for us to understand how would be accounting for CSR compliant companies as well as implementing partners. So when the government has brought in amendment in the Companies Act providing for such stringent penalty provisions, the government is, however, reconsidering its decision and making it an offense. So the inclusion and details of CSR spending in financial statements, enhancement of its disclosure is likely to make CSR framework transparent and robust. So there are now huge spending of CSR. So audit is very important role for the economy of the country. So auditing, why is auditing required? The requirement of audit of CSR activities seems not to be mandatory as per Companies Act 13. However, various provisions of the Companies Rule 14 requires monitoring, reporting mechanism for CSR activities. So what are these provisions which gives monitoring and reporting mechanism? They are Rule 4, 5, 6 of the CSR Rule 14. What does that rule specify? That Rule 4 specifies that the board of the company has to undertake a CSR activity through a company established under Section 8 of the Act, registered trust, registered society, other than those specified, and the company or the trust should have at least 3 years of track record in the similar activity. Now, Rule 5 of the Rule Act says that the CSR committee should institute a transparent and monitoring mechanism for implementation of CSR projects or program or activity undertaken by the company. And Rule 6 says that the CSR should include a proper monitoring process of such projects or programs. So hence monitoring of CSR activities and its reporting is mandatory as per company's Rule 14. So also it is the responsibility of the company through its CSR committee to monitor the funds of the company which are to be utilized as CSR policy of the company. So in case where the company is complying with its CSR obligations by merely making contribution or donation, which specifically allowed as Schedule 7 of the Act, there should not be any requirement of obtaining any report of such contribution made. So, however, the CSR obligation is done through third party as per rules, and utilization certificate of the funds should be obtained from the third party auditor of the company's CSR committee to give effect to CSR compliance, to monitor and report requirement of CSR policies. Now, what are the responsibilities of auditor in CSR? There are two scenarios where a company undertakes CSR activity by itself, and second, where the company undertakes CSR activity through third party, being eligible Section 8 company, registered trust, registered society, and the company should obtain an independent practitioner report on utilization of funds. So let's take the first thing. Wherever a company undertakes CSR activity by itself, what will be the responsibility of the auditors? The auditors should check whether any activity or project undertaken is within the purview of Schedule 7 of the Act. Second, what needs the auditor to check out is mere contribution or donation given, then the same would be as per Schedule 7 or not. Third thing which needs to be checked is whether separate disclosure of expenditure of CSR activity is made as per Schedule 3. Schedule 3 is also amended and it has included various provisions of CSR. We will take up in the next subsequent slides. The expenditure on the project incurred is as per company's Rule 14. We need to check it first. And the expenditure, the company has to check whether all the expenditure are done according to the accounting standard and accounted by the proper accounting standards which are required. What are the accounting standards which we need to check up is SA 250, which is the consideration of law and regulation in an audit of financial statement, and SA 720 revised, which is for auditor's responsibility relating to other information. So the auditor has to comply with the guidance note on audit of expenses. So whenever a company undertakes CSR projects through third party eligible 8 companies or registered trust or registered society, the company should obtain an independent practitioner report on utilization of CSR fund from the auditors or CA in practice of the third party. Now, some general things which auditors of both the part needs to check is that on its website, the company needs to put up its policy and the link to the CSR policy. So the auditor has to check whether the undertaking of an accounting of policy area has been disclosed properly in the policy and website. The auditor should also check whether the CSR report covers the same period as the annual report and specifies the period reporting of the CSR report. Also, the auditor needs to check whether the parent company has prepared a consolidated CSR report that complies with the requirement as to publishing that report and address to the CSR committee. So when the company undertakes CSR activity through third party, the third party has to spend the fund on CSR activity as per section 135 of the Companies Act, which can be read with schedule 7 of the Act. And also verification of CSR spend has to be done as per guidance note of audit of expenses, which is issued by the Institute of Chartered Accountants of India. And the utilization of CSR funds report is to be issued in accordance with the guidance note of reports on certification for special purpose by the Institute of Chartered Accountants of India. So the company should obtain from the chartered accountant and auditor's report on utilization of certificate. So that every funding agency, including CSR corporates, asks for utilization certificate to track their project expenses, which may be audited or unaudited. So generally, unaudited utilization certificate is spent to funding agencies with a signature of head of the organization. So audited utilization certificate was asked yearly or at the end of the project. So what was the problem with this utilization certificate was there was no uniform format which was defined in FCRA or income tax. So generally either a CA gives in its own format or the funding agency would make its own format. So that every utilization certificate had a different format. So the problem was by the holding company. They had to compile all the utilization certificate to make a individual utilization certificate. But the utilization certificate received from small NGOs were in different format. Since all the format of utilization certificate was different, it was very difficult for the auditors to compile that utilization certificate. So solution, what was the solution? To solve this problem, the Institute of Chartered Accountants of India gave specific format to CSR fund. So the specific format is called an individual independent practitioner report on utilization of fund. So the format of utilization report is being issued by the ICI which is duly vetted by the Auditing and Assurance Standard Board of ICAI. So whenever a company is required to compile with CSR regulations under section 135 of the Companies Act 13, it may undertake CSR activity either by itself or by third party. And if it is done by third party, utilization certificate is required. And the ICI has said that the company should obtain a CSR auditor's report on utilization of CSR fund. And if CSR activity is done through third party in any advisory issued by the members of ICI, the company to whom CSR provision under Companies Act 13 said that whenever a company undertakes CSR activity through third party, NGO is advised that all such companies should obtain The independence proportional report on utilization of CSR fund from the auditors or CA in practice of the third NGO parties for implementing CSR activities. So, in such case, the auditors or chartered accountant in practice of the third party NGO is advised that they should submit the independent practitioner report of utilization of CSR. This utilization certificate can be obtained by us by logging into any of the website. If you just log into the CSR website also, you can get this independent auditor's report. It is very specific in its format. First is the introduction part. The second paragraph gives a management representation where you have to take responsibility of the management that they have accounted for the expenses. The next part will be the auditor's opinion, in which we have to give, means the chartered accountant who gives this certificate has to write whether the amounts spent are proper, we have properly done, we got a true and fair view of this expenses, etc. Now, as we know that UDIN is very mandatory for each and every certificate issued by a chartered accountant, for utilization certificate also a UDIN is mandatory. So ICI has given a list of certificate for which UDIN is compulsory, which are there: certificate for grant fund utilization of charitable trust institution, for grant utilization of NGOs, for grant utilization of statutory auditors, and grant utilization under SEMA, FCRA, and other laws. So, Caro, the government is providing various relief measures and relaxation in order to boost businesses and economy. So, in the same context, the MCA has postponed the applicability of companies Caro from financial year 1920 to financial year 2021. And now MCA, while its order 17th December 2020 has changed the applicability of companies Caro Act 2020 to financial year commencing from 1st April 2021. So the companies Caro will be applicable from financial year 21-20, and till then the Caro 16 will be applicable. So Caro is the list of reporting requirements that are needed from the auditors who audit the company and the businesses. So to MCA has issued Caro 2020 to enhance the scope of audit. So the MCA with consultation of NAFRA released Caro 2020. It lists out subject matter on which is applicable by the company mandatory. And there are a list of amendment in Caro 2020. There are no alteration in its applicability, but the Caro comprises overall of 21 clauses against 16 clauses in 2016. 7 new clauses has been entered. 1 clause has been deleted and 1 has been merged. So recently, the MCA notified companies auditors Caro report and has given opinion on CSR in reference to section 135(5) and 135(6) of the Companies Act 14. This 2 section pertaining to transfer unspent CSR amount to PM National Relief Fund. So what will be the newly entered provision will be given in the clause 20, that is reporting on CSR compliance as per section 135(5) and 6. Other than those designated to ongoing CSR project must be specified in the report. We have already seen what is 135.5 and 135.6. So we need not take again what that section means. So in nutshell, a new clause has been inserted in CARO 20, which requires the auditors to report on whether unspent CSR amount has been transferred to a fund specified in Schedule 7, where no specified project has been carried out, or to a designated bank account, which is relating to ongoing projects. Now, what are the duties of an auditor for disclosure of CARO? So this is a very important part part as we are auditors of the company. The auditor needs to evaluate the applicability of section 135 of the company. So the auditor needs to obtain three things: the board approval of CSR policy as recommended by CSR committee, agenda and minutes of the meeting of CSR committee, and third, the working of the amount required to be spent under section 135 of the Act, detailing the calculation of the average net profit calculated as per section 198, read with section 197, which says that there should be approximately 2% of the average net profit. Then the auditor is required to obtain confirmation from the management to review whether the CSR activities are undertaken by the company are in accordance with the Schedule 7 of the Act. And auditors should also verify the amount spent in respect of ongoing projects with the supporting documents, such as expenditure, receipts, bank statements, etc. So in respect of unspent amount, the auditor shall verify the bank account to ensure whether it is earmarked CSR activity open during the financial year or just any other simple account. So specifically, we have to check whether it is unspent account or no. Though the auditor is not required to report under any of the clause of CARO, the auditor is required to verify that the amount transferred to the specific bank account has been utilized for CSR activity as per CSR policy within 3 months, 3 years from the date of transfer. And if the company has failed, it has to be transferred to any of the funds specified in Schedule 7. So the auditor also has to check whether the company has recorded any provisions in the balance sheet, and that provision is as per AS 29 or Index 37, which says provision contingent liability or contingent asset in respect of unspent amount on ongoing projects. So the auditor should also evaluate if the company has considered disclosure of such unspent amount as commitment in the financial statement in accordance with the Schedule 3 of the Act. So in addition to the provisions given in the CARO Act, the auditor should also consider provisions of CSR policy rules of 14 while reporting any unspent amount in the clause. So the CARO says that the auditor may also check, refer to the guidance given in the guidance note of accounting of expenditure on CSR issued by the ICA as per section 135, which is now modified. So now the auditors also have to take a representation from the management regarding compliances and requirement of section 135. There are specific things which we need to disclose in the CARO report. So in case a company has not transferred the unspent amount in respect to ongoing projects to a specified account, a special account or specified under funds under section 135(6) within the time period, then various details has to be submitted in the CARO. And what are that details? Details like relevant financial year, amount identifies for spending of CSR activity on ongoing projects, unspent amount, amount transferred to special account, new date of transfer of the account, actual date of transfer, and number of days of delay. Here the government wants to know if the amount is not properly transferred, then how many days of delay it is happening. So as this is coming in CARO report, the company will take proper care whether this amount is transferred within a specified time or not. The auditor shall also report compliances like in respect of ongoing project, the company has to transfer the unspent amount within a specific period of 30 days from the end of financial year. So they also need to give report like financial year, amount unspent of CSR activity on ongoing projects, amount transferred to special account within 30 days from the end of financial year, and amount transfer after due date. Specify the date of transfer. Here they do not want the number of days in report, they just want the date of transfer. So in situation where the time specified under subsection 6 of 135 has not yet elapsed at the time of issue of the auditor's report, the auditor should report under a clause in CARO on the basis of the information till the date of the auditor's report. So in such circumstances, the auditor should appropriately bring out the fact while reporting under the clause that the auditor may take and write this comment that the company has not yet transferred the amount remaining unspent in respect to ongoing projects to a special account in the date of our report. However, the time period for such transfer, that is 30 days from the end of financial year as permitted by 135(6) of the Act, has not yet elapsed till date of our report. This should be specifically given by the auditors and should not take up on their own to say that why did the company not yet transfer, because the time period was not yet lapsed. There was amendment to the Companies Act 13 in the Schedule 3. What was that amendment? Amendment was that they wanted certain things to be disclosed for CSR specifically. So what was the details which they required to have in CSR? Was the companies covered under section 135 of the Companies Act, the amount required to be spent by the company during the year, and that amount would be calculated as 2% of the average net profit of the 3 preceding financial year. Amount of expenditure incurred. So in this financial year, what the company has expended, shortfall at the end of year means if they have not specifically expended their amount, shortfall at the end of the year, total of the previous year shortfall, reason for that shortfall, nature of CSR activity, details of related party transaction, that is example contribution to a trust controlled by a company in relation to a CSR expenditure as per relevant accounting standard. Related party transaction is also to be disclosed in notes to accounts for CSR and also in board's report. By if the company has given any related party trust that which is wholly controlled by the company itself, such related party transaction has to be disclosed in notes to accounts also for in the disclosures of CSR. And the last one is where a provision is made with respect to a liability incurred by entering into a contractual obligation, the movement in the provision during the year should be shown separately. So in this way, the amendment to the Companies Act 13 in Schedule 3 also requires certain details of CSR, and they are as follows. So with this, we come to an end of our presentation. I can see certain questions. One question is, any restriction on transferring the CSR funds in tranches to the same trust or society? There is no restriction on any amount to be transferred, and can they be transferred in various tranches during various periods during the financial year for the same trust? Transferring of the amount in various periods, it all depends on CSR committee, the policy of the company, and the board, which gives the permission to transfer the amount. Now, first of all, you have to take the board's approval for transferring any amount. And the second is in various periods. I assume that various periods means various financial year. So it first of all, to transfer any amount to the next period required that the project should be ongoing project. So for not ongoing project, you cannot transfer the amount to the next year. You have to transfer it into the any specified schedule of schedule 7. And for ongoing projects, of course, if the board gives approval, then you can transfer that up. The next question is, to become an eligible entity in 12A and 80G, both are mandatory, or 12A alone will do? If 12A alone may do, but if any company or any individual wants to give their contribution, they would always check whether the registered firm is registered and the amount which we are giving for contribution may be eligible for 80G deduction. So it is better that we take the registration of both 12A and 80G as per income tax, because the contributing agency or individual always requires and may have a better chance. The entity may have a better chance to get contribution if it is an 80G registered firm. So any more questions?
Members, any more questions? You can unmute yourself and you can ask directly to the speaker. Any more queries, members? Members, unmute yourself and you can talk to the speaker directly. You can interact with the speaker. So, okay, madam. Thank you very much for your time and effort with the session, and your deliberations really helped our members attended for this webinar. So now I request the Secretary of the branch, C.A. Prashant Kumar, to propose vote of thanks.
Respected Chairman, C.S. Murali, Speaker, C.A. Chairman, senior members, and other dignitaries, good evening to all. I wish to propose vote of thanks for the technical session on my own behalf and behalf of Visakhapatnam branch. I would like to express my sincere thanks for accepting our invitation and for giving an excellent coverage on key development in the accounting and auditing aspects of CSR. Knowledgeable delegations are enlightened our members and who are special focus on areas like capital asset creation, CSR committee, amount of CSR funds, and auditor roles and responsibility regarding amount of CSR declaration certificate and other matters related to the power of clear picture to our members, and it is very useful to our members while they are discharging their duties in their practice. Thank you very much, madam. And regarding to the upcoming programs, on 12th June, we have a session on Code of Ethics by CA J. Venkateswamy from Hyderabad. I request the members, please join the session and get benefited. I also extend my thanks to all the members who have joined and got benefited in this section. I also thanks to our chairman for giving this opportunity. Thank you very much, sir.
Thank you, sir, for giving me again this is opportunity in your branch for the second time. Thank you so much.
Thank you very much, madam. Thank you very much. So members, there is one more announcement on the occasion of International Yoga Day, which is on 21st of this month, Monday. So we are organizing 1 week virtual yoga program for all our members. That will be starting on 15th of June, Tuesday onwards. Every day, morning 6:30 a.m. to 7:30 a.m. 1 hour yoga session at this pandemic time, which will be very much helpful to our members. The breathing exercises and which are all relevant fitness program we are conducting for a week time. So I request members to make best use of this facility and attend this in good number. It will be from 15th to 21st, every day morning 6:30 to 7:30. Thank you, members. Thank you very much, madam.
Thank you.
Thank you, madam. It was a good session for us.